We are witnessing the real-time implosion of the American auto market. This is not just a slowdown, it is a full-blown credit catastrophe. As of 2025, more than 7.5 million vehicles have already been flagged for repossession. Lenders are forecasting that figure to swell to a staggering 10.5 million by the close of the year, which would be the largest spike in history. Monthly car notes that once averaged $450 are now surging past $900 to $1,100. Absolutely devastating households already buried by the rising costs of food, housing, and insurance. Defaults are accelerating faster than they did at any point since 2008, and the foundation of the system is beginning to crumble. What is unfolding is not merely a problem with cars, it is the first visible sign that the broader economy is fracturing. America's auto finance industry is collapsing under its own weight, and it wasn't caused by a single bad move. It's happening because every single layer of its structure is failing all at once. With over 100 million car loans active, the entire system relies on a steady stream of monthly payments to keep lenders in business. That stream also keeps the secondary market for these loans running. Now, that stability has been shattered. The moment a car owner is 30 to 60 days late on a payment, the lender initiates a repossession assignment, which is the official alarm bell that a loan is in deep trouble. In 2025, these repo assignments have skyrocketed past 7.1 million. This is the first stage of a systemic collapse, a tidal wave of defaults that is overwhelming the entire credit system. But the mechanics of this crisis run much deeper. Over the last 3 years, the average car purchased with financing came with a debt of $34,000 to $48,000, with the payments stretched out over 72 or even 96 months. These enormous loan balances mean that nearly every buyer is underwater from day one. The second their income drops or an unexpected expense of just $200 to $300 appears, the fragile payment plan shatters. This is because the loans were structured to be at the absolute limit of what a person could afford. Once a payment is missed, lenders are forced to move toward repossession because the car itself, the collateral, is losing value faster than the loan balance is shrinking. Each week of waiting means greater losses for the lender. Meanwhile, shifts in interest rates have driven typical APRs from a 4 to 6% range in 2020 to between 8 and 12% today. This instantly bloats monthly payments and speeds up the journey into default. And with auto insurance premiums jumping by 20 to 40% nationwide, that financial strain creates a direct pipeline to repossession. A single missed payment triggers a domino effect that ripples through the lenders, the debt collection agencies, and the complex investment bundles that are all built on the assumption of reliable cash flow. The outcome is a cold, automated loop of failure. Loans become unaffordable, leading to mass defaults, which triggers repo orders and ends with the cars being sold at a loss. This cycle forces banks to tighten credit for the future, which in turn causes even more people to default. This is not a short-term problem. It is a fundamental malfunction of an overextended system that is now buckling. As we saw earlier, the sheer scale of the 2025 crisis becomes clear when you compare it to recent history. In 2022, the U.S. saw 1.22 million car repossessions. By 2024, that number had already climbed to 1.73 million, a level not seen since the aftermath of the Great Recession. 2025, however, has already smashed every record on the books. Over 7.12 million repossession orders were filed before the year's final quarter had even begun. Financial analysts are now projecting that this number could blow past 10.5 million by December. This suggests that 1 in every 10 vehicles with a loan could be at risk this year alone. What makes this situation so terrifying is the sheer speed of the collapse. The rate of repossessions hasn't just doubled. It has quadrupled or quintupled in less than 18 months. No other credit sector, not mortgages, not credit cards, not student debt, has ever imploded this quickly. And unlike in past downturns, this is all happening while official unemployment remains below 5%. This fact alone reveals how precarious family finances have become after years of inflation eroding their buying power. Another critical piece of data going unnoticed is who is actually falling behind. For the first time in over a decade, borrowers with prime and near-prime credit are accounting for a large percentage of new defaults. Internal bank documents show that in the second quarter of 2025, more than 34% of the borrowers who defaulted had previously maintained credit scores over 660. This indicates that the financial distress is widespread and not just confined to a single high-risk demographic. The timeline of these repossessions also points to a more fundamental breakdown. Lenders are admitting that the average time between a first missed payment and a repossession order has shrunk from 78 days in 2019 down to just 42 days in 2025. The finance industry is acting faster because the vehicles themselves, now valued between $30,000 and $50,000, depreciate so quickly that they cannot afford to wait. This accelerated timeline is inflating the raw number of repossession orders and confirms that the financial stress is overloading the system in real, measurable ways. Taken together, this data reveals a truth that the headlines are simply not covering. The 2025 repossession crisis is not a routine market fluctuation. It is a credit shock of historic proportions, unfolding at a velocity the auto industry has never before witnessed. What set off the 2025 explosion was the incredible price distortion that warped the market between 2020 and 2024. New cars that used to cost around $34,000 began selling for over $48,000. Many of the most popular trucks and SUVs soared past the $55,000 or $60,000 mark. Even used cars, which are typically the budget-friendly choice, saw prices leap 35 to 45%, and they never came back down. This runaway inflation pushed millions of consumers into gigantic loans that were financially doomed from the start. Well before the default numbers began to surge, the trap was engineered directly into the deals themselves. Loan durations were stretched from 60 months to 72, 84, or even 96 months, not as a choice, but as the only way to get the monthly payment down to a manageable number. But financing a rapidly depreciating asset over such a long term created a guarantee of immediate negative equity. In just the first year of ownership, many cars lost $6,000 to $10,000 of their value, while the loan balance barely budged. The instant that families came under financial pressure, as we've already covered, this dangerous imbalance turned into a catastrophe. Making matters worse, the price gap between new and used vehicles shrank to the narrowest it has been in modern times. Buyers were paying $29,000 to $32,000 for used vehicles, which saddled them with monthly payments as high as what a new car buyer would have paid just a few years before. Factoring in insurance costs that were rising 20 to 40%, volatile gas prices, and increasing maintenance bills, the total cost to own a car surged far beyond what people's wages could support. This pricing environment directly caused the explosion in repossessions because it trapped owners in loans that were impossible to refinance. Rolling over negative equity from one car to the next created a snowball effect. Each time someone traded in a vehicle, they added another $3,000 to $7,000 of old debt onto their next loan. By early 2025, millions of American families had cars worth 20 to 40% less than their loan balances, which turned every missed payment into an almost guaranteed loss for the banks. This financial engineering did more than just inflate the cost of cars. It turned basic transportation into a massive leverage bubble. And while we've already seen the shocking scale of the defaults, we now understand how this pricing model ensured those defaults would inevitably become the historic repossession crisis that is happening right now. The most powerful catalyst for this wave of repossessions was the interest rate shock that hit families after the borrowing boom of 2020 to 2023, when rates were safely anchored around 3 to 4%. During that time, even an overpriced car seemed affordable. But as central bank rates climbed, the average APR for new auto loans shot up to 7 to 9%, while millions of people in the middle risk tier were handed contracts with rates of 10 to 14%. Those in the subprime category were hit with even more brutal terms, with some loans being approved at over 18 to 22%. This sudden spike added between $150 and $350 to their monthly payments. This change immediately turned already strained budgets past the breaking point. The pricing trap we've discussed turns lethal with these interest rates, as higher APRs mean the bulk of your early payments are consumed by interest. During the first year of a 72 or 84-month loan, you're hardly chipping away at the principal, so the amount you owe remains high while your car's value plummets. This structural flaw keeps borrowers deeply underwater for years, leaving them completely exposed to any financial shock. And what's often overlooked, in the past, people could get out from under crushing car payments by refinancing. But by 2025, that door has slammed shut. Since interest rates have skyrocketed to almost twice what they were before the pandemic, trying to refinance today just means locking yourself into an even bigger payment, offering no relief at all. This leaves families stuck with a monthly bill they can't change, shackled to a payment that becomes impossible to make as soon as inflation drives up the cost of groceries and gas. Seeing this danger on the horizon, lenders cut back on how much time people had to catch up on late payments and started using much stricter rules to evaluate risk. Because soaring interest rates are making the car's value drop faster than the loan balance does, each single missed payment now translates to a much bigger financial hit for the lender. And that's precisely why the entire industry is now moving to repossess vehicles at a speed we've never seen before. This spike in interest rates isn't just a minor issue in the background. It's the central trigger turning market imbalances into a full-blown wave of defaults. When you combine these skyrocketing financing costs with the shaky loan deals we've already talked about, you get the hidden engine driving the 2025 repossession crisis. What started as a problem for individual families is now snowballing into a major credit market meltdown. Subprime lending, the the most fragile part of the system, is the fuse that's lighting up this entire breakdown. From 2020 to 2023, there was a huge explosion in loans given to borrowers with credit scores under 620, all because lenders were desperately chasing higher loan volumes and the profits that come from bundling them up for investors. Getting a loan became much easier. Lenders barely checked if people could actually afford the payments, and stretching loans out over longer periods became standard practice. By the time 2024 rolled around, more than 22% of all new car loans were being handed out to people in the subprime or even deep subprime categories. We hadn't seen a percentage that high in over 10 years. This massive pileup of risk was exactly what set the stage for the first cracks to appear. And when that interest rate shock we talked about finally hit, it slammed this group of borrowers harder than anyone else. While borrowers with good credit were getting rates somewhere between 7 and 9%, those in the subprime category were routinely signing deals with rates from 15 to as high as 22%. For a car costing anywhere from $28,000 to $32,000, that gap in interest rates jacked up the monthly payment by an extra $180 to $280. That was an extra cost that many of these families just couldn't handle, especially once inflation started driving up the price of everyday necessities. Not surprisingly, the number of people falling behind on their payments in this group shot up, climbing by more than 60% in early 2025 compared to the year before. The thing that transforms this from a personal crisis into a ticking time bomb for the whole system is how the modern car loan business works. They package these risky subprime loans together into complex financial products called asset-backed securities. These financial products are built on the assumption that money will keep flowing in consistently. So, when people start missing payments right away, the value of these securities begins a downward spiral of credit downgrades. This pressure forces lenders to get much tougher on who they'll approve for a loan, to pull back on taking risks, and to speed up repossessions just to try and get some of their money back from the cars. This reaction is what directly fuels that surge in repossessions we mentioned before. But there's another critical piece of the puzzle that often gets missed: the fact that subprime borrowers have zero positive equity when they try to trade in their old cars. Figures from 2025 reveal that over 85% of trade-ins from subprime borrowers were underwater, meaning they owed more on the car than it was actually worth. That often meant that anywhere from $3,000 to $6,000 of old debt was simply added on top of the new loan. This cycle of piling on old debt ensures these families can never get ahead. They are always underwater, which means the slightest financial hiccup can instantly push them into default. So what started as a contained problem in one corner of the credit market has now become the spark that's setting off a massive explosion in repossessions. It's a vicious cycle. Distress in the subprime market leads to bigger losses for lenders. Those losses force lenders to tighten credit, and that tight credit stops struggling families from being able to refinance or work out a new deal. This dangerous feedback loop, which is directly tied to the interest rate spike we covered earlier, is precisely the fuel transforming the 2025 crisis into a full-scale credit meltdown. This wave of defaults isn't just devastating families. It's also ripping through the financial statements of lenders at a pace the industry hasn't seen since the mortgage market imploded. Just like back in the late 2000s, when someone stops paying, the lender has to go get the car. The problem is, the financial reality of repossessing a vehicle has become incredibly harsh. On average, just the process of repossessing a single car now costs between $1,100 and $2,000 when you factor in towing, storage, paperwork, and all the other related expenses. And even after all that, when the car finally gets to auction, it typically sells for 20 to 40% less than what's still owed on the loan. Take a $32,000 loan on a car that's losing value fast. The lender is lucky to get back just $18,000 to $20,000. That means they're eating a loss of $10,000 to $14,000 on every single vehicle. And that financial bleeding gets catastrophic when you're talking about millions of repossessions. According to internal projections from the major lenders, they could be looking at write-downs of more than $15 to $20 billion if only a small portion of the expected repossessions actually go through. This intense financial squeeze is what's compelling lenders to speed up the repossession clock, which is a direct extension of the credit tightening we saw during the subprime meltdown. Moving fast becomes their only option. It's not because they can avoid losing money, but because every single week they wait, the car becomes worth less and less, making their losses even bigger. And to make a bad situation even worse, the financial products built from these bundled car loans known as asset-backed securities or ABS are starting to show serious signs of stress. The specific portions of these securities that rely on payments from subprime borrowers are now facing the threat of downgrades as more people fall behind. The moment these instruments are seen as weak, lenders suddenly find it much harder to get affordable funding. Their cost of borrowing goes up, their available cash dries up, and they're forced to get even stricter with loan approvals. This is the exact path by which a crisis for everyday families turns into a major problem for the financial institutions themselves. Meanwhile, car manufacturers are slashing deals and incentives. The supply chain is still unreliable, and high manufacturing costs are keeping the sticker prices on new cars stubbornly high. This perfect storm crushes the demand for new cars at the exact same time that a flood of repossessed vehicles is hitting the used car market at a deep discount. The auctions are completely flooded with cars, which sends resale values plummeting even faster and makes the losses for lenders worse with every single month that goes by. This steady financial decay, tied directly back to the systemic flaws we've already discussed, is what's turning this wave of repossessions into an all-out meltdown for the lending industry. It isn't just about loan agreements or sudden interest rate hikes. It's the quiet, steady drain on take-home pay that comes from relentless inflation. While official reports may suggest that price increases are slowing down, the reality for most people tells a completely different tale. The cost of absolute necessities has climbed far more than the reported averages. Since 2020, inflation has driven grocery bills up by 35 to 60%. Meanwhile, insurance rates have shot up even more dramatically. Car insurance premiums have jumped by 28 to 46%, and it's now common to see home insurance go up by 25 to 40% in many states. For a typical family, these increases are siphoning off an extra $350 to $600 every month, and that's before they even touch their loan payments. This squeeze from rising prices is directly tied to the crisis in the used car market we mentioned. As the value of their cars plummets, the weight of their fixed monthly payments grows heavier in comparison. Families who are already on a tight budget simply can't handle simultaneous price hikes on food, power bills, rent, and insurance while trying to keep up with payment plans that were set up in a completely different economic climate. This creates a situation where the rising costs of daily life automatically push people toward financial trouble. Another factor people often miss is the increase in required spending, things like healthcare deductibles, prescription copays, and utility bills, which all rose significantly through 2024 and 2025, creating a constant drag on finances. Even small increases, like $40 for one thing and $75 for another, pile up until one unexpected expense is enough to turn an on-time payment into a late one. The inflation surge also wiped out household savings. The amount people were able to save dropped below 4%, leaving them with virtually no cushion for emergencies or a sudden loss of income. This financial erosion makes the underlying structural problems we've discussed even more dangerous. When the cost of basic necessities rises faster than people's paychecks, every fixed debt payment feels disproportionately larger. The entire system relies on consumers having a stable flow of cash. Inflation shatters that stability. As a result, households begin to default, not because they were irresponsible with their loans, but because the economic ground shifted right under their feet. This is precisely why inflation has become the hidden fuel for the surge in repossessions in 2025. It turns the cost of living into a direct assault on people's ability to manage their debts, contributing to the domino effect already transforming the auto and credit industries. The immense financial pressure squeezing families today is not a coincidence. It is the outcome of a century-long erosion of the U.S. dollar's value, which began with the creation of the Federal Reserve in 1913. Over that time, our currency has lost between 97 and 99% of its buying power. It now takes $30 to $35 to purchase what $1 could in 1913, and this decline has picked up speed over the last 2 decades. This chronic devaluation is the unseen foundation for all the financial hardships we've examined. Sky-high car prices, heavier interest payments, and the fact that things are becoming unaffordable all stem from a monetary framework that systematically weakens the currency. Several key moments made the situation worse. In 1933, the government's forced confiscation of gold instantly devalued the dollar by 41%. Then, in 1971, severing the dollar's link to gold transformed it into a currency backed by nothing more than faith in the government. From that point forward, inflation was baked into the economy as a permanent characteristic, not just a temporary problem. This is the reason why wages have consistently failed to match the rising cost of living, a pattern that leads directly to spikes in late payments and defaults. The official responses to economic crises only made the decline worse. The quantitative easing policy after 2008 swelled the Federal Reserve's balance sheet from $900 billion to more than $4 trillion. Later, in 2020, stimulus efforts pushed that number past $9 trillion, flooding the system with money that drove up asset prices, warped the credit markets, and kept borrowing costs artificially low. While these actions offered a short-term illusion of affordability, they set the stage for long-term instability. They also directly contributed to the soaring car prices and the interest rate shock we've already covered. At the same time, the national debt skyrocketed from $900 billion in 1980 to over $38 trillion today, requiring constant money creation. just to support government spending. Every one of these cycles chips away at our purchasing power. When the cost of basic needs goes up simply because the dollar is worth less, households find it impossible to keep up with their fixed loan payments. This decay is directly connected to the inflationary squeeze we just discussed. A devalued currency makes every financial weight feel heavier. The repo crisis is more than just an issue of consumers falling behind on payments. It is the eventual outcome of decades of monetary policy that has gutted the dollar's value and destabilized the entire credit system, ultimately preparing the ground for the credit crisis that is now beginning. The explosion in car repossessions is not an isolated problem. It is the first domino in a widespread economic downturn that starts when millions of loans go bad all at once. Lenders are hit with billions of dollars in losses, which compels them to make it harder to borrow money across the board for cars, for personal use, for credit cards, and even for small business operations. This credit crunch throttles consumer spending, which in turn causes revenues to drop for retailers, manufacturers, and service providers. As car sales drop and factories scale back production, the fallout starts to affect jobs. The automotive industry is responsible for over 4 million jobs, both directly and indirectly. A downturn in manufacturing, shipping, logistics, and dealership work only adds to the financial stress that families are already experiencing. Due to inflation and their diminished buying power, the falling prices of used cars then create a vicious cycle on lenders' books, worsening their losses on future repossessions and forcing them to tighten lending even more. This feedback loop gains speed until the entire economy feels a coordinated slowdown. What started as a few late payments at the family level evolves into a nationwide scarcity of credit, fewer job opportunities, and unstable asset values, a domino effect rooted in the fundamental weaknesses that became apparent throughout 2025. The surge in repossessions isn't really about cars. It's a clear warning from a system that has been pushed beyond its breaking point. When millions of people can no longer afford to pay for essential debts, it's a sign that the very foundations of the economy are cracking. America is not just dealing with a vehicle market problem, it's witnessing the opening act of a major financial reckoning.